Okay, so we're going to jump into it here, but first I want to bring on a special guest of ours. He's our sponsor for the day, Gary Mobbs. He's got some resources that are available to any of you who are currently self-directing or interested in self-directing. One of the things that we talk about is you don't need hundreds of thousands of dollars in a retirement plan to buy real estate in your retirement plan. There's actually, believe it or not, banks out there that will loan money to your IRA or your self-directed 401k to help it leverage some other money to help it buy more real estate. So, Gary, want to bring you on with South Star Bank. Introduce yourself and tell people a little bit about yourself.
Yeah, thank you. Thank y'all for having me on today. As you said, my name's Gary Mobbs. I'm a senior vice president. I've been with the bank here for 20, going on 20 years now. Um, our bank is based out of a little community called Moulton, Texas, right here in Central Texas, not too far from Austin. We're a 104-year-old community bank, and we started into the self-directed IRA lending here probably about 7 years ago. And we started off doing it primarily in Texas, but we saw some opportunity here a few years back outside of Texas. We had a lot of inquiries of people that were needing assistance with the specialized lending outside of Texas. And so we ventured out. And so we've started doing it, in other states. And we're just continuing to expand it. It's been a great program, and we're really excited. We love to do this stuff. I really enjoy educating people on the process and working, of course, with people like Directed Trust and some of our other great custodians out there that you know help a lot of people invest in a lot of alternative investments. It's a great deal.
Gary,
Um,
give the people a little bit, just a little bit of a snippet, an idea of the types of properties your bank will lend on and
sure.
where they'll lend.
Sure. So we primarily try to stay with 1 to 4 family. Um, Now I say that we'll do a few one-off deals. Like I did a deal in St. Louis, Missouri, not too long ago it was a sixplex instead of a fourplex. It made sense. It was in a really good location. I've done a couple one-off deals, from time to time, but we try to stay primarily with 1 to 4 family, and we really like rent-ready properties. That's kind of what we stay with.
Would it be inaccurate to say that if somebody has a property that they're interested in leveraging some of your bank's financing to buy it in their IRA, that they should send you the deal and just see if you'll do it? Because as a
Yeah,
community bank, you can kind of work outside the box. You're not restricted like a
right.
Chase or Wells Fargo or somebody like that.
Yeah, absolutely. I would just say if you got a deal that you think sounds good, send it to me and let me look at it.
Awesome. Awesome. Gary, if you can put your information there. We already got some people asking the name of your bank, contact information. And again, I always say, guys, if you're interested in leveraging some bank financing, call a couple, see, compare them out. The good thing about these types of banks is they can create their own products. So you might get a little bit of variety between one bank or another bank. And Gary, one more question. Are your loans, do you qualify almost like a DSCR loan? Is it based on the rents in the area and the down payment just getting to a certain point where it's comfortable for you as a bank?
Yeah, so we'll normally do these with a minimum of 40% down. And our target debt service coverage ratio on these is 1.2. So what we try to do is if the property is already leased, of course, we'll do our analysis based upon an existing lease. But if we don't have a lease in place, then typically what we'll do is we'll order the appraisal with a rent schedule in there, and we'll confirm what the projected rent for the property should be based upon the rent schedule in the appraisal. And that's basically how we underwrite these. I mean, it's a pretty simple process. There's no, we don't underwrite the IRA holder at all. All we do is underwrite the property itself. So there's no credit report, there's no tax returns, there's none of that. We're just looking at the property and trying to determine whether or not, it cash flows. Um, you know, generally speaking, what I've learned in today's rate environment right now is that most of the deals that I look at, the property needs to generate typically about 10% annually of what the gross sales price of the property is. And that's with 40% down. I don't know. That's just kind of the numbers. That's the ratio that tends to work. So,
Awesome. And we got a question again. I don't know if you guys caught that. This has no bearing on your credit. This is not a loan
yeah.
to you personally. You're not personally guaranteeing the debt. This is just a loan, basically an asset-based loan to your retirement plan, so that your retirement plan can buy a piece of real estate with just a down payment and not come in with all cash. So it's a different type of loan. It could be very advantageous. I just talked to an investor that's already tapped out with his conventional loans personally, and now he's going and he's putting property in his IRA because it doesn't affect his credit. There's no bearing to him. So Gary's a good resource for you guys. We'll have his information up on the website as well in the next week or so. So thank you, Gary. We appreciate it. Oh, Aaron's got something he wants to add.
Gary, repeat that last percentage ratio for the coverage, that 40% down, 10% annual. Really repeat that one more time for everyone.
Yeah. So what just in playing with the numbers on these a lot, what I've learned is that generally the property needs to generate about 10% of the gross sales price of the property annually, to make the numbers work with 40% down. So in other words, $200,000 purchase price, they put, 40,000, or $80,000 down. Basically what you would need to make sure of is that the property generates $20,000 a year, in revenue to make the deal work. So.
Awesome.
Okay. Awesome. Thank
Yeah.
you so much.
Yeah, so truly asset-based loan for your IRAs or 401ks, guys. So thanks, Gary. We appreciate it. I know we'll have you on again soon. And guys, don't be afraid to reach out to Gary if you guys are interested in that. So let's just jump into it. I've got some slides I want to share real quick, and then we'll bring on our special guest speaker, Nathan Turner here. So I know a lot of people are new to the program, so just want to talk a little bit real quick about who Directed IRA is. The problem that we solve for people who have retirement plans, whether it's an IRA, an old 401k, an old 403b, there's a problem a lot of investors face where they feel like they're restricted as to what they really want to invest in. So Directed IRA solves that problem of limited investment choice. And on the program today, you've got myself. I'm the Vice President of Sales and Strategic Relationships here at Directed IRA, and Aaron Halderman, a good friend of mine, known Aaron for years. He is the COO here at Directed IRA. We both invest in notes, so you got us both on here, as well as our guest speaker, Nathan Turner. As we go through here, anything that's presented on any platform of Directed IRA is only education based only. We don't sell investments. We're not financial advisors. We're not telling you guys what you should or you shouldn't invest in. That's not our job. Our job is just to provide you the vehicle to use to enable you to self-direct your retirement plan. But when it comes to self-direction, the person that ultimately does the due diligence on the investments and chooses the investments is you, the IRA owner, the self-directed 401k owner. You tell us what you want to own in your retirement plan. And there's a process that we'll talk about how that works when you want to use your retirement plan to buy real estate, to buy notes, to create notes, to buy seller finance notes. We'll talk all about that here, but we don't give tax, legal, or investment advice. And even our speakers are forbidden to pitch any deals. They're just giving you good education so that you have an idea of what you can invest in and how that works in a retirement plan. Directed IRA, and by Directed Trust Company, we're a licensed trust company out of the state of Arizona, the only licensed trust company out of the state of Arizona to provide self-directed IRA accounts. And when we talk about self-directed IRA accounts, we're really talking about IRAs, 401ks, even health savings accounts, education savings accounts. These are all tax-exempt plans that you're not limited to just investing in stocks, bonds, mutual funds, and CDs. You can invest in almost anything inside of those plans. But when it comes to investing in what we call alternative assets like real estate, syndications, land, notes, private equity, private stock, cryptocurrency, there's a whole world of alternative investments out there. And if you want to own alternative investments in a retirement plan, you can't work with a Fidelity or Charles Schwab. You have to work with a company like Directed Trust Company that will hold those types of investments on your behalf. When you look at the tax law doesn't prevent us to what we are allowed to invest in. There's only two investments on this planet you're not allowed to own inside of a retirement plan. And those investments are life insurance contracts and collectibles. Most people don't realize you can invest in real estate and all the alternative investments that are out there because we're not going to outmarket your Fidelities or Charles Schwab. You're probably never going to see a commercial from Directed IRA. But most people see Fidelity and they know, oh, I can invest in those things because those companies not only custody retirement plans, but they also sell financial products. And that's why when you ask your guy at Fidelity or Charles Schwab, can I invest in real estate or can I invest in notes? Can I do a private loan? They're always going to tell you no. The reason they say no, it's not because you're not allowed to do it in a retirement plan. It's because they don't sell those types of investments. So when you have an IRA at Fidelity or Charles Schwab, you're only going to be able to invest in traditional investments. But when you have an IRA at Directed IRA, our account agreement with our clients simply states we'll hold anything the IRS allows, but you got to tell us what that investment is. And that investment can broaden the spectrum of your investment options by just having a self-directed IRA. Now, truth be told, most of our clients, I would probably say 80–90% of our clients have an IRA here at Directed IRA to hold their alternative assets. And they also keep an IRA at Fidelity or Charles Schwab to hold their brokerage assets or their paper assets. There's no limit as to how many IRAs you're allowed to have. But if you want to diversify and get into alternatives, you need to have an IRA with a company like Directed IRA that'll hold those types of investments. And you can move money back and forth depending on where you want to invest it between those two types of plans. When we talk about self-direction, this is for the new people. Don't get confused when we say self-directed IRA either. This is a common misconception that a self-directed IRA is some different type of IRA that fits different sets of rules. No, IRAs are IRAs are IRAs. An IRA at Fidelity is no different than an IRA at Directed IRA. We just hold different types of investments. When you look at the types of plans we have here at Directed IRA, they're the same types of plans you have other places. We call it self-directed because we don't sell investments. You have to tell us what the investment is, but we have 6 types of plans that you would find other places. We have personal IRAs that can be self-directed, which would include your traditional or your Roth IRAs. If you're self-employed, you have another page on the menu. You can self-direct your SEP IRAs or even a solo 401k. Probably one of the best wealth building tools in the self-directed IRA space is that solo 401k if you're self-employed. And then we even have non-retirement plans that can be self-directed that can help pay for today's needs with tax-free dollars, which would be a self-directed health savings account and a self-directed Coverdell education savings account. I'm not going to spend too much time on these plans because we've got other classes. If you go online, you can find other classes that go deeper into these plans. But these are the 6 products that we have here at Directed IRA that will allow you to invest in alternative assets, including seller finance notes. And when you look at these plans, what you want to think to yourself is every one of these plans is just its own buyer. They're taxed differently, but they can all invest into the same things, either individually as plans investing in one asset here and one asset there, or you can partner plans together to invest in the same investment. Now, oftentimes we do that through what's called a checkbook control IRA LLC. Again, we're not going to talk too much about that on this program, maybe toward the end as we talk about the process of buying notes. But there's ways that you can bring these plans together to invest in the same things, okay? Whether that's a note or a piece of real estate. But when you look at these, remember, these accounts grow much faster than money in your back pocket because these accounts are not taxed. If you want more information and want to learn a little bit more, just fire up to our website, directedira.com. We've got a ton of education, probably the most education out there in the self-directed IRA space. Just hit that Learn tab. You'll find a lot of information about what a self-directed IRA is and how it truly works. But just for this program, I wanted to give a little bit of detail just on the process about how do you actually take a retirement plan, whether it's an IRA, traditional IRA, a Roth IRA, a solo 401k, and how do you actually invest it into alternatives? It's really broken down into 3 steps. Open the account, fund the account, invest the account. Opening the account, it's so easy. It takes you 5 minutes. You can just do it online. And I'll give you some resources and a promo to make it a little bit cheaper for you guys at the end. So stick with us. But basically, the first step to self-direction is just open a self-directed IRA. The second step is you fund your self-directed IRA either through a contribution out of your back pocket, transfer from one of your other IRAs. You can transfer some or all of the cash in one of your other IRAs. It's totally up to you. Or you could do a rollover from an old 401k or an old 403b. So if you've left your job, you're retired, maybe you've got just an old plan with an old employer, those funds can most definitely be rolled into a self-directed IRA. So that's step 2, fund the account. Step 3 is where the self-direction piece comes in, and you have to tell us what that investment is. And if I broke it down real simply, any self-directed IRA custodian is going to need 2 things. They're going to need your instruction to make the investment, and they're going to need the investment docs. And our instruction for us to make the investment, it's called our direction of investment form. You can find them right on our website. They're all e-signature, very easy, takes you 5 minutes to fill out. You give us that as your instruction to us that this is the investment I want to make. And if it's a note, there's going to be a specific direction of investment for a note on our website. And with that direction of investment, we just need a copy of the note agreements. Whether that's if you're buying an existing note, we might need a copy of the existing note and any assignments of interest along with that note. Maybe it's a transfer of lien or a longe. We'll talk a little bit about the nuts and bolts of it here, but we always need 2 things: a direction of investment form and the investment agreements. Okay. And you work with our 5-star investment team to help you get that money out of your IRA and into that alternative investment. And then we'll hold the investment. We'll hold those docs as evidence of your investment, just like Fidelity holds stock certificates as evidence of your investments there. So why do people like notes? Why do we have such a big audience when it comes to notes? Well, notes are passive. You don't have to do a lot of work once you own it. Okay? You might have to just make sure borrowers make payments. It's a good diversification tool. A lot of people are looking for diversity right now, especially with the stock market going wild. People are looking for other avenues to give them a little bit more safer return, or maybe just it's an investment that they know and understand better. Maybe they just like real estate better than they like mutual funds or stocks. Tax savings is a big one. Again, all those plans that you can self-direct are all tax-exempt trusts by definition. So they grow either tax-free or tax-deferred, depending on the type of IRAs you have or the IRAs you invest. And here's the one thing that I personally like about note investing in an IRA or 401k is that it's predictable. You know what you're going to get. You know what the payments are supposed to be. You know what the payment schedule is supposed to be. And at the end of the day, if your note is secured by real estate, you know what you have as collateral if those payments stop coming in, which is usually the house. So this is why a lot of people gravitate towards note investing. Even though we talk so much about real estate, I would probably say a vast majority of people like to be more passive with their retirement investments versus the active piece and going out and finding, real estate of their own. So, but ultimately, what a self-directed IRA allows you to do is just invest in the things that you know best. And that's kind of our catchphrase: is invest in what you know best. And you could do that through self-directed IRA. So I want to bring on Nathan Turner. Nathan Turner, I've known Nathan for many years now, and Nathan actually had bought one of the existing note conferences, and I will just say leveled it up over the last couple of years. It seems like every time we get out there to the Diversified Mortgage Expo, it becomes a bigger and badder event. Went to there, got an opportunity to speak there. It was a great event. Tell people a little bit about maybe the event first, and then your story, and then I'll let you jump into it and talk about seller finance notes from your perspective.
Very cool. Hey, thank you so much for having me on here. This is great. I'm a big fan of just people getting together. So my conference is Diversified Mortgage Expo. I guess the background on that is I went to my first note conference back in 2009. So way back when, and started learning about notes and how they work, and started investing in notes in 2010. It was just a couple of years ago I was approached with taking over this conference, and I thought that sounded like a pretty good idea, so off we went. But I'm a big fan of just getting in person and in front of people. I think that makes a big difference. So Alternative Asset Summit coming up. I'm sure you talk about that a little bit later, but it just makes such a difference to be in person. Zoom is great, and we can do all kinds of things online, but man, oh man, there's nothing like getting face to face with people.
Yeah, and I apologize. I want to bring in Aaron Holderman because Aaron is also a note expert too. A lot of people don't realize this, but I knew Aaron back, I don't know when we first met, probably 2012 was when we first met at a noteworthy event. Aaron was doing notes, way longer than, even doing the self-directed IRA stuff. And now we're a happy marriage here at Directed IRA. So, Aaron, anything you want to add? I know even you and Nathan have run into each other at note conferences. So we were always running into each other and running around in the same circles before we actually came and met each other all here.
Yeah, I'd say good to have you on, Nathan. Always good to see you.
Yeah,
And thanks for having us out and at your last event in Nashville. Always fun to be in Nashville too.
for sure.
Uh, so I would say like note investing, there's so many avenues that you can go at it. I first started investing in discounted distressed notes and having to do like a lot of fixing of the notes. And then we're going to talk today on seller finance notes. And I know Nathan has a good deck here that's we're going to do a deal, no deal section, which will be fun for y'all to participate. And so this will be interactive here in about 5-7 minutes. Having started in real estate and then going to notes is just, you become like a better real estate investor. So I'll say, because you learn how to use a financial calculator, you learn how to analyze the underlying borrower themselves, and you kind of have like a little bit of the best of both worlds, in my opinion. It's like you get the appreciation and some equity when you own property, but you also get a lot of the work that comes with that too, dealing with toilets, tenants, trash, and all that stuff. But when you become the bank and start investing in notes, you're now the lender. And so there is no toilets, tenants, and trash. Instead, you're looking at the borrower's ability to perform on paying you, because you're essentially stepping into the shoes as if you're, a small bank yourself, being the lender, where they're paying you, that interest income, which is either tax deferred or tax free. And that's why we love doing that in a self-directed IRA, because that's how that can be possible, tax deferred or tax free. And so it just makes you a better real estate investor overall, and how to better structure creative deals by getting it in notes. And, you can buy some that are already paying. You can buy some that are not paying and have to fix them. Or you can create notes, which we'll talk about today on seller financed paper. And I've done a little bit of all of it. And it's all great. Of course, you don't get any of the appreciation, equity, but you also don't get any of the headaches. But you can also trade the paper, which is a much different mechanism than you having to sell property. When you're trading paper, you're shipping out collateral files and doing an assignment and an allonge. There's very little recording of anything going along, and so it's much easier for you to step into the shoes of somebody else and trading that paper and being the lender. And so we'll talk about some of that today. So yeah, bringing it full circle, Nathan and I just met at different note conferences that were out there, and he's spoken at some of the ones I used to do years ago. I haven't done them in like probably 7-8 years after getting into the self-directed space. But it's awesome to hold notes in a self-directed IRA or a solo 401k, or you're doing the work and that's your business, and you're looking for investors that are self-directing their retirement, and they're a great avenue that are looking for kind of that interest income. So we're kind of coming at it from all angles, depending upon how you want to do it, how you want to invest, how you want to play in the game, both with retirement funds or maybe just personal funds, a little bit of both. You either doing it yourself in a retirement account, or like I said, selling it to others, and that's part of your business model. So Nathan's got a ton of experience. He'll talk a little bit about the structures and how he's done it both personally and in a licensed regulated fund. And so we're happy to have you, bud.
Hey, absolute pleasure. Good to be here.
That's all I got, Nate.
That's it.
Yeah, go ahead and share your slides there, Nathan.
We're done. All right, let's do this. So this is a presentation I put together a little while ago about, it was really targeted towards people who maybe have a note that they're looking to sell. But we'll talk about some of the different structures and how that works, and what a note buyer is looking for, what matters to a note investor and what doesn't, and kind of reasons for that. So yeah, that intro, I kind of went over that already. I started doing note investing back in like 2009, 2010. That's really when I got started. When I first started, it was all about seller financing. So I was actually buying property and then selling on terms, creating seller finance notes. When I first got started, I had no idea that's what it was. I didn't know that's what they were called. I didn't know anything. But it was a lot of fun, learning and growing as we went. And that was really good. Went from that into, same as Aaron, started buying a bunch of distressed non-performing notes where people were in the house or not in the house, but in either case, they were not making payments on their mortgage. And when I first heard about that, I thought that was crazy. That sounded super risky. As I started doing it, I realized it's not at all, actually, because we have that house as the collateral to back everything up. And so that's a really big deal. If you acquire the house, if that's the way it goes, then you can wholesale that out. You can seller finance it. Most of all, if there's somebody living there, we can get them making payments again and get them back on track, which is fantastic. Aaron mentioned I have a fund. We just opened this up last year where we are collecting money into the fund, where I go out and buy performing notes, which are much less risky and far more predictable, still secured by the real estate. And so that's something that I do, and then mention the conference as well. And so that's a ton of fun. If you're looking to learn more about it and get to know people in the business, I highly recommend checking that out as well. So here's where this came from is I get a lot of deals pitched to me, and which is great because I like to buy notes. That's what I do. But what I started to see was a bit of a pattern of people that are creating seller finance notes and talking about things that I frankly don't matter to me. They don't make a difference to the note itself, and they don't make a difference to how much I'm going to pay for that note. So I was being pitched about things like renovations that they had done. So the person that owned the note would come and say, "Hey, I've got this note for sale. It's on this beautiful house. We just renovated the kitchen. It's got granite countertops. It's got, brand new this, brand new that, beautiful appliances, on and on and on." I actually don't care. That sounds wonderful. I'm so glad that the house is in nice condition, but it actually doesn't make a difference to me as a note holder because I'm not buying the property, as Aaron mentioned. I'm just buying the paper that's attached to that property. So in the end, what I really want to know is, what is the value of the property? So all those renovations are lovely and that's great. How much is the house worth? That's really what I want to know. So they'll talk about the neighborhood and how it's such a nice neighborhood, and there's, schools next door, and there's shopping close by and all those kinds of things. Again, I'm not buying the house, so I don't actually care. That sounds nice, and it sounds like a great place to live. And perhaps that means that somebody's going to be happy living there and happy to make payments, but that doesn't actually translate. People are going to make payments or not, they're not going to make payments, whether it's in a really nice neighborhood or in a not so nice neighborhood. But that's not something I generally care about. One that is a little bit, perhaps in a little bit different category where I care, but I don't care, is after repair value, ARV. So here's where I don't care is if you're coming to me and said, "Hey, I've got this note, it's on this property. The people in the house are going to be renovating it, and they're going to be living in that house long term. After repair value is whatever it is, $100,000 more than current value." That's great. My experience has taught me that if it's people that are going to be moving in and doing the work while they live there, we've all done this where how many projects we moved into our current home 2 years ago, there's still one block of wood that I haven't replaced up in that one corner. Is it a big deal? No, not at all. It's actually probably nobody ever notices except for me, but I just don't think of it at the right time in the right place. So uh, my point is, oftentimes people have repairs that they intend to do and sometimes don't get to for all kinds of different reasons. So that after repair value in that sense is not even a real number. That's a projected possible after repair value if they actually do the repairs. Where it does matter to me is if it's a short-term loan situation. Let's say somebody comes to me with a note that is a 12-month term, and it's specifically for somebody who's doing a fix and flip. In that case, yes, then I do care about that because they're doing it as a business and with a purpose in mind. So that's the kind of thing where it does matter, and that's something I would look at. But I wanted just to bring that up that yeah, oftentimes people have all kinds of intentions on doing property repairs that never get done. So it's not a real number. Rents in the neighborhood, rent is great, but that doesn't necessarily translate into whatever the monthly payment is for that borrower. If somebody down the street is paying $1,000 a month, that doesn't necessarily mean that on this note, $1,000 a month is what we should expect. They don't necessarily correlate. They might, but it's not something that I'm going to necessarily take as any kind of calculation. I'm not going to include that in my calculations of what value that note might have. And then this is another big one that I see often is PITI. So that stands for payment, interest, and taxes and insurance. So I've been surprised at how many times I've gotten a note and they'll tell me the monthly payment and they'll include taxes and insurance. So that principal and interest payment, that's like your regular mortgage payment. But then oftentimes when somebody comes to me with a note they've got for sale, they'll include not just the principal and interest, the regular mortgage payment, but they'll also tack on the taxes and insurance number. And as if that's like their monthly payment. Well, yes and no, because yes, that's what the borrower is paying every month, but the taxes and insurance are not, it's not my money. That's money that's set aside in escrow that gets paid by the servicer. So it's not income for me. So I need to know that just the principal and interest payment, because that tax and insurance number doesn't mean anything to me. That's not my money. That's not something I get to keep or hang on to. So that's another big one. I've seen that often where people say, oh, it's $1,200 a month. And say, okay, does that include taxes and insurance? Oh yeah, it does. Okay. What is it? Minus that out, take that out. What am I actually getting paid every month for that principal and interest? Because that's what I get to keep. So those are some things I just almost a bit of a rant where I get these notes pitched and I go, okay, I'm so glad you did those renovations. Great. I don't care what's the value of the property. And just kind of going through and talking about things that don't matter. So if that doesn't matter, then what does matter? Let's look at that. I am looking at things like interest rate. That's like one of the first things that I'll look at when somebody has a note for sale. And the reason is that interest rate can make all the difference in whether that's a sellable note or not. And what I mean by that, and we'll go into some more detail here in a little bit, is let's say this was a note that was originated by the bank in 2021, right when rates were at about 3%. If I'm going to buy that note, I'm going to look at that and say, okay, my target yield is 12%. In order for me to get to that 12% number, that discount is going to be massive. It's going to be huge just because there's such a big difference between 3 and 12. So in that case, that's probably not a deal that's going to go anywhere just because we're too far apart. On the other hand, most seller finance notes are done at a higher interest rate. And that's something that hopefully is being done. So the quick story, I was in Utah at a RIA meeting, and there was a realtor that came in and he had this note that he was looking to sell, and he was telling me all about it. And the issue was at the time, this was last year. So at the time, I think rates were at about 6%. And he came to me and said, okay, so I've got this note for sale. The interest rate was, I think, like 5.5, whatever it was less than what the bank was offering. And so I said, so how come you're offering less than what a bank offers? And he said, well, because we're getting full value of the property. And we were on two different planes, and I could not communicate to him that you're offering seller financing because whoever the buyer is can't get a loan from the bank. That makes you a specialty product, and you should charge more for that. Besides which, I'm going to pay more for a note that has a higher interest rate than a lower interest rate. So if you're out there and you're creating mortgage notes, that's my biggest piece of advice for you is charge as much as you can, making sure, of course, that the borrower can still handle that kind of monthly payment. So again, that's kind of my going off on a little bit of a rant. Make sure that your interest rate is as high as it can be while still making it attainable for that borrower to make payments. It's going to get you the most money for your note. The UPB is the unpaid principal balance. So the unpaid principal balance, we're going to go into more detail, but that's the number that I'm looking at. So there's going to be two different numbers when we're talking about your note. We're talking about the unpaid principal balance, and we're also talking about the value of the property. Hopefully there's a big difference there. There's some equity built in, and we'll go into some detail on that. I want to know about the down payment. How much did that borrower put up for a down payment? We'll go into detail on that. Things like term. Is this a 20-year term, 25-year term, 30-year term? Those are the kinds of things that I'm looking for. When was the first date paid? What kind of note is this? Is this mortgage, or is this a deed of trust? Is this a contract for deed? Is this a lease option? Like, what kind of security instrument is backing this up? Big one is underwriting and RMLO. RMLO is your registered mortgage loan originator. So if you're not familiar with that, I highly recommend you become familiar. That is, let's go back in history a little bit again, 2012 or 13. Aaron, if you know for sure, you can correct me. CFPB.
Yeah, Dodd-Frank.
Yeah, Dodd-Frank. Was that 13?
I think it was back in 2010, actually.
Okay, but then I think
it was originally published in 2010.
Yeah, and then I think it came into actual law either 12 or 13, something like that. In any case, that actually changed what I was doing back then. So I was doing a lot of the originations, and then that law came into effect, or those guidelines, law, whatever you want to call that. We actually stopped originating because I knew that we needed this mortgage loan originator, and I could not find one anywhere. It was just such a brand new concept that they just didn't exist. They do today, which is great. But that is the mechanism that's been put in place to help make sure that the borrowers have that ability to repay. So for myself, I'm a big proponent of that. I think that's an important piece to have in your note investment criteria, is making sure that any seller finance notes have gone through that process. If they haven't, that's not necessarily a deal breaker, but we will still have to get them qualified through the RMLO after the fact. So it makes a difference, again, when I'm looking at a note and deciding how much I can pay for it.
And Nathan, I want to chime in just real quick.
Yeah,
there was
please.
a question from Dee Yon. Dee had a couple questions, but since you're talking about Dodd-Frank, her question was, is this only working on investment property or homestead? Obviously, Dodd-Frank is only on homestead properties. It doesn't
Right.
really reflect or affect you if you're, buying a note secured by investment property. Go into a little detail about that for people that don't understand Dodd-Frank.
Sure. So Dodd-Frank, the whole idea with Dodd-Frank was to help protect borrowers. Um, what we saw, kind of in the 2000s were, if you remember, what was that? Ninja loans where no income, no, how did it go?
Yeah, the no doc, no, you just breathe on a mirror, you get a loan type of
Yeah.
loan. Yeah, those
Yeah.
loans.
And for some reason, people decided that maybe that's not a good idea. Probably a good idea to make sure that these people actually have the ability to make payments on the whatever loan they're getting. So that was kind of the whole idea behind Dodd-Frank, and that's how that kind of came to be. Um, Personally, I think they went a little bit overboard, but it was, a knee-jerk reaction to the situation at the time. There's work being done on reforming that, but all that to say, that's the at the heart of it. That's what they're trying to do, is making sure that borrowers have the ability to repay and holding mortgage lenders accountable to show that they've actually gone through and done that homework to protect the borrower.
Right. So
So that part
if
of
your
my family.
borrower, yeah, if your borrower is living in the house, you gotta understand and know Dodd-Frank laws. If it's an investment property, different. You don't have to abide by anything for Dodd-Frank. So just something
Right.
as a note investor you should know.
Right. So that's specifically, like you say, Nate, that's specifically for borrowers, like people that are living in the house. If it's a company, Dodd-Frank actually does not apply in that situation. So if it's somebody that's doing a fix and flip and they're using their LLC, Dodd-Frank doesn't apply. So you don't have to abide by those same kind of laws, same kind of requirements. Just checking out these other questions here. Okay, we'll get into some specifics here in just a little bit. Same kind of analysis process for a contract for deed or a structured lease option. Yes, ish. Yeah, it's a little bit different. Every note that you're going to look at is going to be just a little bit different, and so it's important to, I think, look at them individually. I'm a big fan of that. I've worked for a time at a hedge fund where we were looking at pools at a time, and in that case, when we're looking at hundreds of notes that we're buying at once, we would spot check. We would kind of go through that list and pull out. If we were buying 100 notes, we'd maybe look at 15 or 20 and just kind of randomly go through and pull out documents and make sure that they all looked the same. If they were different or if there's something weird, we'd look at more. But that's a good question, but we're looking at a one by one basis. Good question. So let's go into some details here a little bit. Discuss UDFI. Sorry, I'm not familiar with that.
It's
Yeah.
it's a tax. So Nate, you can hit on that real quick and talk about for non-recourse loan and how.
Actually, I was going to save that. We'll save that to the end, but I was going to send
Okay.
Mark. I'm going to send you a link on that. Kind of off topic, so I want to let Nathan get through his slides here. But I got you, Mark.
Perfect. All right, so I wanted to just go in a little bit, kind of some specific ones here that are the big ones for me. So the interest rate, like I say, you're not a bank. Bigger is better. For any kind of note investor, the driving force for a performing note investor is yield. We're looking at yield. So that's like the number one thing, which means the higher that interest rate is on the note, say it's a 10% interest rate. If again, my target yield is 12, I'm going to have a much smaller discount in my purchase price. It's going to be much easier to get a deal done. So that's my pitch for that, making sure that you've got that dialed in. Unpaid principal balance. This one kind of introduced. So this is, if you think of your own mortgage, you know how every payment you make, a little bit goes towards principal and typically a larger portion goes towards interest, depending on where you are in the cycle of your loan. Near the beginning of the loan, almost all of it is going towards interest and just a little bit's going towards principal. As time progresses, that actually changes and goes down. A number of years in, that'll actually flip-flop where you're actually paying more towards principal, less towards interest. But that's kind of that curve, and you may or may not have seen that before, but that's how that works. So we're looking at your amortization schedule. That's how we calculate that principal balance. So that takes into account all the payments that you've made and figuring out where on that chart you are. And that's kind of how that's calculated. You can easily do that with a financial calculator. If you're not familiar with that, I think that's one of the major failures of the school system. I'm a huge believer that that should be something included in high school because it's far more applicable to everyday life. But if you're not familiar with it, check out, there's all kinds of YouTube videos and things. I've got a financial calculator on my phone, on my computer, on my laptop, and I use them all a lot. Almost daily basis when I'm looking at notes, especially, but big deal. But that's also taking into account the down payment, what the monthly payment is. This is kind of just a thought, an idea for those who are creating notes, doing an 80-20. So you do an 80% first, a 20% second, sell off the first, keep the second. That's maybe a whole other class, but kind of a cool idea. It helps build in an investment to value ratio. So it makes it a little bit easier to sell. Helps that make it kind of a safer note for somebody who's looking. You can keep the second or you can sell the second. Personally, I'd keep it. Might as well have some cash flow. But like I say, that's a whole different, that's a different class.
Still a secure lien. So, but
yeah, absolutely.
Hey, Nathan, I had a question. It was a good question on another one that I watched just for the audience. How do you verify unpaid principal balance?
Oh, good one. So seller finance folks and talking about myself as well. So when I first started doing seller finance, I didn't even know what servicing was. I was just collecting payments and I loosely knew the calculator and could tell you how much somebody paid. It gets challenging when they're making partial payments or late payments or things like that. If your payments were always perfectly on time and up to date, then that would be very easy. But it's often where payment streams get messy. For that reason, use the servicer. So I would highly recommend that. At the very least, it's a third party that's calculating and receiving those payments and passing on that payment stream to the next buyer. So that just helps make that a more attractive note in that case.
I would probably assume it gets a little hairy if you're buying a note from a non-servicer or a note that wasn't serviced, right? It's mom and pop that have a note that you're verifying their work. There's obviously got to be a document in there somewhere where you sign off on their knowledge of the unpaid principal balance.
Right. Yeah. There's lots of different servicers out there. We can talk offline if you're looking for one, but there's lots of good ones out there. So I highly recommend. It's not a huge expense. Typically, they charge a flat fee, anywhere from $20 to $40 a month. So if you've got a note that's paying $1,000 a month, that's almost nothing. If you've got a note that's paying $200 a month, that's a little more. But it's a wise investment for sure. So we talked about this a little bit about RMLO and the importance of using that. The penalties for not using an RMLO, the CFPB has very far-reaching reach when it comes to being able to slap penalties on you and things. So it's really worth it. Make sure it goes through that RMLO. Like I say, if it's not necessarily a deal breaker. I probably wouldn't pay as much for that note because I'm going to actually go back and requalify that borrower. I will run them through an RMLO and get that fixed so that it's up to date and done properly. Hopefully that's a good indication that it's well worth it doing it up front. The borrower often covers the cost for that, which is typically not very much, $500-600, maybe up to $750, something like that. But depending on who you hire to do that, but again, a cost that is well worth it, and you may not even have to shoulder.
Wayne has a question. Ramsey, RMLO is a residential mortgage loan originator. And then Wayne had a question. Wayne, I think your question will be answered. He's talking some specifics about a note, like would you lend on this 5 years at 12%? I think you've got some deal or no deals that'll kind of cover that. Why don't we pick your best two out of the ones you got? And if other people, are you happy to share your other slides with people if they shoot you an email?
Oh yeah,
We
for
can
sure.
call them.
Absolutely.
Okay.
Yeah.
Yeah,
Yeah.
let's get to maybe the two best ones because I'm interested to see these deal or no deals.
Sure. So let's go with this one and then the last one. So these are deals that I was actually sent. They're deals that I was looking at, and I'll just go through it. This is the information I was sent, and then we'll open it up, see what kind of comments we get, whether people think this is a good deal or not. Here's what I was sent. It's a first position loan to be assigned at the close of escrow. So in other words, it's a brand new note. There's no seasoning on this. Property is in Park Forest, Illinois. Sale price of the property, $130,000. Down payment, $10,000. So then you've got a balance of 120 over a 30-year term, 360 months. Interest rate 10%, monthly payment a little over $1,000, and an ARV of 190.
Okay, so we got D is confident. They say deal all day. They jumped at that one. So
In
I'm
on
in,
this one?
yeah.
All
D says
right,
deal
cool.
all day.
Here's a couple of maybe not red flags, but yellow flags at the very least. So number one, Park Forest, Illinois. Illinois being the issue there. First of all, Illinois requires a debt collector's license. So if you don't have that, you're going to maybe want to steer clear. That's my first issue with this one. Next one for me is the sale price is 130 and down payment $10,000. For me, that's not a big enough down payment. I want at least a 10% down payment on that one. So that's, again, for me, that's a kind of red flag. And number three on this one, my third red flag on this is ARV is 190. I don't know that that's a true number. I don't know if they're actually going to do the repairs to bring that value up or not. And so there's too many unknowns. It's a little bit cloudy for me. But any other thoughts on that? Any, Aaron or Nate?
No, I agree on that. I mean, if you're just solely looking, like those are yellow flags. The biggest one actually is the debt collector licensing. That's the biggest issue that I see in that deal. Don't really, yeah, sure, I get the ARB. They may or may not do the repairs. Who really care?
Yeah.
But the biggest one is the debt collector. The down payment, that's still 10 grand. It takes a lot of people nowadays to invest in 10 grand, and it was only bought for 130. So that was
Yeah.
still, decent. My biggest thing is the debt collector's license. So when some people ask questions, they D ask too, like what kind of licensing and stuff do you need? In some states you are required to have a debt collector's license. And in fact, if this is like your business, not your investing like side hustle or side deal where you're buying a couple notes a year, you're whether personally in an entity or in a self-directed IRA. If this is like your business, then you're going to need to go through the process of getting licensed in all the states that you're doing business in.
Right.
You can kind of do it under a sub-servicing umbrella with a licensed servicer. But even then, if you're doing that, then you're beholden to going through them to do all the workouts, all the curative work, meaning if the borrower stops paying, they're going to use their attorneys. You're going to have to pay them directly. They're going to be doing the calling to the borrower. your company is just using them, under the umbrella of subservicing, but they are the servicer, and because they have the licensing. So the licensing that you need, if you're doing the underwriting yourself, you could be an RMLO, or you could pay somebody who is an RMLO a flat fee to do the underwriting. So you may need that, or just contract for that. And likewise, just everything I just said, you may need a debt collector's license if this is the business you're in.
And I'll just play the devil's advocate just for fun, just for the whole audience, is when you're especially when you're talking about your self-directed IRA investment, everybody's different. Everybody's going to like deals and not like deals. That's okay. It's not a template that everybody has to follow this or that. If you live in Illinois, this might be a great deal for you. It might be in your backyard, right? That might be better. That might be safer for you to have something that's down the street, and whether you get the licenses or not, that might be a better investment than, say, me doing it sitting here in Phoenix, Arizona. I don't have boots on the ground in Illinois, right? I still got loans in Texas because I know people in Texas, but again, it's all personal preference. And when it comes to your self-directed IRA, the notes you put in there are your choice, not ours, not Nathan's. It's up to you guys. So that's the beautiful part about it, is you can pick and choose your investments where they're at and how they're structured. So
Nathan,
just
how
want
much
to be the other side.
Nathan, how much are you paying a flat fee RMLO for most states?
Most states, $500 or $600.
There you go. So
Yeah.
like if it was a more complicated state like New York, New Jersey, maybe Illinois, you might pay a few hundred more for that. But
Yeah.
there you go, $500 plus.
Yeah.
For those of you who are wondering, a debt collector's license, you can look that up, but that's something governed by the CFPB.
Every state's going to be a little different on that one.
Yeah, it's quite a bit of work, quite a bit of paperwork.
Yeah.
You can hire companies like, I think Cornerstone's one that you can hire that'll go out and do a lot of the paperwork for you, and you're going to pay them a fee to get licensed. It's a great business. Listen, but 10 years ago, you didn't have to do all this.
No.
But Dodd-Frank changed all that. And so if this is your business like full time, and you're doing like, let's say, more than a handful, then you're in the business of it, and you're subject to a lot of these things.
Yeah. So I'll say one more thing on this one. That's it's kind of a yellow flag, but again, it really comes down to preference. This is a brand new note, so there's no seasoning. We don't know, any kind of a pay history on this borrower.
I should be getting a discount for that, right?
Yes.
If I'm taking the risk, I should be getting some sort of discount, and I'm not.
Yeah. And typically in this kind of a situation, for me, if it's a brand new note, that doesn't scare me. However, if it's my requirement on that is it has to have gone through an RMLO. If it's gone through an RMLO and it's a brand new note, I'm fine with that. If not, then that's an issue.
Should we do one more? Nate, can we do one more? The last one?
Let's do one more. Whoop. Let's do this one.
I love it.
Okay. This one, first of all, way more information sent to me.
Love that.
I like that a lot. So a single family in a mortgage, sale price, 180 down payment. There's your 10%. Then we've got a balance there, 240. So that's a 20-year loan, 10%. No balloon. Like the other one probably didn't, but this guy actually tells me. Property location, let's skip over on the other side there. Spencer, North Carolina. North Carolina is a little bit hairy, but generally I actually like North Carolina. It's a little bit, when I mean hairy is if the people here don't pay and I have to go through and do a foreclosure, that's a little bit more involved in North Carolina. But otherwise,
it's a judicial state, isn't it?
It is, yeah.
Yeah. So you can write that in your notes: judicial versus non-judicial.
Right.
There is a difference for foreclosing.
This one, the other interesting thing about this one is a non-owner occupied. The payor, the person that's making the payments on this, is a commercial construction business owner. So this is a income property for him. And this is kind of all the rest of the information on there. So at the very least, I like all the extra information that I've got on here. I like that they did a 10% down payment. I like that I've got, current balance. So they've made a couple of payments at this point versus the original balance at 162. So they made a few payments. That's nice. That makes me a little more comfortable. All in all, I'm a fan of this one. I don't have any real issues on that. I think that's pretty good. Any other thoughts for you guys?
I'll say I liked it when I saw non-owner op just because that's what I lean toward because I just don't like dealing with Dodd-Frank. Plus, if I have to foreclose, I don't want to, move somebody out and deal with that. But again, that's just my personal preference. I'm not saying
Yeah,
it's right or wrong to have, owner occupied, notes. I like North Carolina. I've always been a big fan of North Carolina.
me too.
Obviously, it's a little bit, hairier to foreclose in North Carolina, compared to like say like a Texas or something like that. But yeah, I mean, it would be more up my alley. What about you, Aaron?
Yeah, I just don't love that it's non-owner occupied and um, there's less feeling and attachment to the property versus like when it's a person's primary residence. So
Sure.
Sure.
they're going to treat this more like a business transaction versus like, well, this is a family and they want to stay in the home, they want to work a deal with you. They and then the other negative that I see is what we already talked about. It's a judicial foreclosure state.
Yeah.
The,
Yeah. Judicial
otherwise,
closure a little longer.
otherwise it looks good.
Interesting. So, and then, like you say, Nate, sometimes, I mean, a lot of the time, it really comes down to personal preference and what
Mhm.
you like and what you don't like. Um, the old adage in note world is there's no such thing as a bad note, just bad pricing. And it really comes down to that. So much of it can be fixed, which is really
Yeah.
nice. So
Yeah.
that's that's what we've got. I think we could talk for days, but anyway.
Here's a good question, and this is the one of the questions I had. So Jeffrey Keating had a question: why would a person want to sell the mortgage to a note investor? That's a
Oh,
good one.
excellent question. Yeah. So what it comes down to is in this case, they're receiving, what was it, $1,000 a month, $1,500 a month, which is great. But let's say the holder of the note, they want to, I don't know, send a kid to college. They want to invest into a different business opportunity. They want to renovate their kitchen, whatever the case might be. They want a lump sum of cash today versus that $1,500 a month. So that's what it comes down to is they're much more interested in having a lump sum. Uh, Maybe it was, a husband and wife and one of the spouses passed away and the other one doesn't want to deal with it. I mean, there's all kinds of reasons where they just would rather not deal with it. They would rather have that lump sum today, all kinds of things.
Yeah, I've seen it. I've seen it time and time again. I mean, especially the clientele that we work with. We deal with a little bit older audience that has retirement plans, and I've seen. I had a note investor that had dozens and dozens of notes, all and most of them performing. And he decided that he wanted to sell some of his performing notes at a discount. People are like, "Why?" I mean, they're paying because he was done. He wanted to cash out. He wanted to live in retirement. He wanted some of this money cashed out and just keep a sum. So you never know when you're going to run into a deal. Sometimes, some of these notes are performing, they've got equity in the property. And on the specific deal that I'm thinking of, someone bought it in their HSA, actually. It was a small note, like $30,000 note, bought in their HSA.
Mm-hmm.
And the borrower on it was about 12 months from paying the note up, but the guy was just ready to retire. The original lender was ready to retire. And
Interesting.
ultimately, when they bought the note in their HSA, the person actually paid off the mortgage in like 6 months. So that obviously, when
Yeah.
you went back to the biggest number is yield, that just like shot their yield up because they anticipated to be paid off in 12 and it got paid off in 6. And they're like,
Yeah.
well, shoot, I just got paid off all that interest in earlier rather than later. So you never
Yeah.
know. It, comes from all different places why someone would want to sell a note.
Just one
Yeah.
correction because this is being recorded for all you fact checkers. So North Carolina is non-judicial. It's South Carolina that's judicial.
Okay.
You
Good.
can list it. There's like way more non-judicial than judicial, but judicial tip the one of the bigger ones actually is Florida that
Yeah.
most people don't know about. So you have Florida, Illinois, Indiana,
Mhm.
Kentucky, Louisiana, New
Yeah.
Mexico is one surprising one. Then you have Ohio and Oklahoma, also kind of surprising.
Mhm.
Yeah,
But there's
typically they're longer, the judicial states, but I would say, and this is what I've heard from, again, investors we have in North Carolina, that even though they are a non-judicial, it's a little bit slower than some of the other non-judicial states. So it just depends, it's state by state. You got to understand the foreclosure laws in every state, and some states have different foreclosure laws on owner occupied property versus non-owner occupied property in some cases with redemption rights and things like that.
Yeah. So, I mean, obviously, you can tell anybody who's listening, if you could hear three note investors going, I mean, we could do this for hours, and we often do, but go around and around and pick apart deals and what's good, what's not. It's a ton of fun. There is a lot to learn. If that's something you're into, it's such a great business, and I'm a big fan. If you're like, oh wow, that's really cool, but there's other avenues. I've got my fund. There's other funds out there, and then that's truly passive, and it's a fantastic IRA investment.
And D has one more. This is a good one to wrap up on. What is the investor club on your website? How can we be a part, and what's it cost to join? I guess I get you talking about maybe the DME, or just how they can find more information, education.
Investor Club is coming on board and becoming part of my fund. So go ahead and do the contact me. I think it is in there, or whatever that case. I forget what it says, but
Yeah, if you
contact
want
me. We'll
if
talk
you want
more.
more information on that, contact Nathan directly. Again, we're not promoting or endorsing any investment.
hit your last slide, Nathan.
Right.
There you
That's
go.
my contact info.
And then Nate, you want to share the last promo slide before we
Yeah,
wrap it up?
let me just wrap it up here. And you
Yeah.
guys, if you have any other questions, you can email Nathan directly if there are questions for him. If you've got questions for us, I'll give you my email here as well.
While Nate's pulling that up, thanks so much, Nathan, for sharing your information experience. Well, what I see a lot of people do, a lot of our clients do at directed IRA is there's two really investments that make up like 80% of what a self-directed IRA investor invests in. One is real estate in some way, shape, or form, whether it's fixing and flipping, lending, investing in notes, promissory notes. The other is investing in syndications, a fund. Some people call it, a fund, a syndication, whatever you want to call it, but it's a licensed and regulated entity where somebody had to pay money to an attorney to get a private placement memorandum that's then you can pull it up on the SEC's website and see what kind of fund it is specifically, because there's a bunch of cute numbers that designate them on, if you're accredited or not accredited, can you use an IRA to invest in it. But that's our other really big investment that we see a lot of clients go into. What's cool about that, though, is what Nathan just mentioned. It's like you're seeing kind of all the benefits of somebody operating a business, but on somebody else's like dime, your dime as the investor, but you probably have another full-time job or something else. But you're able to like see all the systems, processes, all the tools, resources, how they manage vendors, how they manage the assets, how they manage the investor relations and all that by going into somebody's fund. So there's definitely some advantages to doing something like that versus you saying, hey, I'm just going to go buy a note and figure it out all out of my own. I didn't even do that. I had to like join a coaching club, go to a few meetings. I bought a home study course, went to several 3 live day trainings to figure it all out.
Yeah.
But then but like 10 plus years ago, there wasn't many people operating funds that were investing in promissory notes. Now there is. So you can kind of have the advantage of seeing behind the curtains, if you will, if you chose to go down that kind of lane to learn for education. Like that's one of the things I actually learned from my dad too, is he would go invest in various things that he didn't know much about. Like, let's say it was self-storage. And he's like, son, I want to get into this business. I was like, I know nothing about this business. He's like, well, we're just going to invest 50 grand in this fund and we're going to figure it out. I'm like, that sounds pretty good. But we did the due diligence, they're licensed, regulated. So just give me a little bit of perspective and context of how you can, look at this from a different lens as well.
Yeah, and I'll just tag on one thing we didn't get to talk about too much, but I heard this on another note, educational seminar talking about IRAs too, and specifically when you're talking about interest payments, you don't get tax deductions on interest income to yourself personally. That's why it's so attractive in an IRA. And I heard somebody say this, and I just love it. He goes, if you're doing it in an IRA and you're not doing it in a Roth, you're doing it wrong. So, because there's all different types of IRAs that you can use, and if you're going to do it tax free, why not do it in a Roth IRA? And again, like Aaron mentioned, syndications, rental property, and notes are good assets that actually can create, if you do it right and have proper due diligence, can create income streams to your retirement plan. And if you own it in the right type of retirement plan, like a Roth, you could just take tax-free distributions of that interest income tax-free for the rest of your life and never have to pay Uncle Sam a dime. So marrying those two concepts together, income producing assets with tax-free accounts like a Roth or a Roth 401k, even an HSA, produce you tax-free income for the rest of your life and pass it on to your heirs. So if you want to learn more about, self-directed IRAs, one piece, but also just alternative investments in general, we've got our big conference coming up in October. We still have a few tickets left for you guys. If you want to get tickets for $100 off, we've got GA tickets available, and we've got a few VIP tickets available. They're almost sold out. But use that code NATE100, go to altassetsummit.com or just scan that QR code. We only do this event once a year, guys, and we're going to do it October 24th and 25th in Scottsdale at the Orange Tree Resort. It's a 2-day education only event. We have probably 15 plus speakers that are some of the biggest names in the industry when it comes to alternative investments, talking about everything from single family, multifamily, short-term rentals, sub-2, angel investing, oil and gas, mineral rights. I mean, the best of the best are going to be at our Alternative Asset Summit. And we only do it once a year. So if you guys want to come out and attend, get tickets before they're gone. It's going to be an investment into yourself more than an investment into the event. I assure you that. And then if you guys are interested in setting up a call, either with myself or somebody on our team to talk about your self-directed IRA options, just scan that code, or again, go to directedira.com, book a call. We always encourage anybody who's starting off, book a call with one of our IRA executives. Let them answer your personal questions. Let them walk you through the process and find out if self-direction is right for you. And if you find out it is right for you, use that code RYR100. That's Rethinking Your Retirement 100 to get you $100 off any account that you establish with us. So that can save you hundreds of dollars if you're setting up multiple accounts. And if you need to email me, there's my email address as well. So Nathan, I want to thank you, buddy, for sharing your time with us. Again, if you guys are interested in learning more about notes, I mean, his DME is probably going to come up in less than a year. It's one of the best events out there. Nashville is a great town. Me and Aaron were out there. We had a great time. I hope you guys see us there, or I hope I see you guys there. And if you guys have questions for Nathan, you got his information as well. So thank you guys. We appreciate all your time. Have a great rest of the week, everybody.